the flows into a country like India, irrespective of what is the outcome, say if there is a 10% correction, flows would come into our country?
I think the way India is positioned is clearly as a low beta market as far as emerging market fund managers are concerned. There is now a great track record to prove that we are domestically focused. Our resilience to economic growth has been extremely good over the last decade or so. We are reasonably well insulated from currency market perspective as well as even from the bond side. There still is room for cuts. So I think in an environment where globally countries and economies are struggling with deflation, with demographic deficit, we really have very different problems. And therefore, from an overall perspective, I would say I wouldn't even think that we would need a 10% fall in markets for foreign investors to come back into India.
Right. As far as numbers are concerned, what do you make of that? At least the numbers are pointing out that if there is no major recovery, at least the downtrend or the downgrade cycle would have also stopped.
Sure. I think on the aggregate numbers, because of few lumpy cases like few corporate banks, we have had this issue wherein, at the aggregate or the headline numbers, there have been some cuts in earnings. The way we look at it is, of course, one needs to look at the aggregate numbers as well for the larger indices. But what we particularly track is on the breadth of the market. What I mean by that is we look at the investable universe and we see how many earnings have been upgraded post the results and how many have got downgraded. Now it's been almost 2 quarters since we've seen an uptake in terms of upgrades to downgrades, because that really reflects the overall corporate health of corporate India. Rather than purely looking at just one profit number or just one EPS number for Nifty or Sensex. So far as this quarter is concerned, it's still early days. We have maybe about 60% of the companies that have reported thus far. Of these companies, clearly there are few sectors that are standing out, primarily consumer discretionary. I think they have had a reasonably good set of numbers, be it in autos, be it in durables. I think that is an area which continues to show reasonably good numbers. From sectors like IT, pharmaceuticals, where pretty much nothing was expected, I think even from those numbers, there have been some amount of disappointments due to varying reasons. Cement is another sector where I think numbers are reasonably okay, despite this being a low seasonal quarter because of monsoon. So I think it's a bit more nuanced the way we look at it. We don't think that there is a matter of grave concern because of the earnings. In our view, the big earnings quarter should be Q3 and Q4. Q3 primarily because it's a festive quarter. Also, with respect to the pay commission release as well as the overall release, you should start seeing that money flowing through as far as the consumer wallet is concerned. So our big bet would be on Q3 and Q4 to make a decisive call on earnings momentum as far as Indian earnings are concerned.
Right. Also, the base effect in Q3, Q4 would become favorable, so growth rates would be higher.
That's right. You're spot on. So that really is an optical thing, but clearly even without the base effect, we think momentum should be reasonably good because of both the festive season spending as well as the release of the monies from pay commission as well as overall. So we remain reasonably watchful of the Q3 and Q4 numbers to really determine the aggregate health of corporate India.
Right. Before we go on to sectors or stock, just wanted to understand about the mid-cap markets as well. You think valuations over there are particularly quite high or expectations are high, but you think that they would be able to deliver?
See, I don't think it's any secret that mid-cap valuations are high. Clearly, we are in a market where growth is still being scarce. We are not seeing growth being pervasive all across the breadth of the corporate world. And within that growth, be it large cap or mid cap, where there is growth, I think markets are rewarding. So if you just as an example, companies like Maruti, which is possibly one of the mega caps in India, are getting appreciated by the fact that growth is reasonably strong and there have been upgrades. And the same would apply for mid caps as well. So wherever there is growth, markets are giving them a thumbs up at this point of time. Now, the universe of the mid caps is close to about from the 101st company by market cap to say about 300 or 400 companies, which is the investable universe for professional fund managers. Out of these 400 companies, are there 30, 40 companies that have got a growth window of anywhere between a compounding of 25 to 30%? We definitely do think so. So it's going to be a bit more selective rather than that huge rush that we saw from 2013 onwards, wherein, any and every mid cap and small cap has given fantastic returns. But I would think that it needs to be a lot more stock specific at this point of time as far as mid caps are concerned.
Right, but a tactical idea, if somebody is overweight on mid cap, would be to shift towards the large cap space. At least the downside would be limited.
We would think so. Clearly, large caps haven't moved up in tandem with mid caps, and therefore the extent of fall, should there be a global event or a global risk off, should be limited. I think it is in that context that we believe that large caps also offer good risk-adjusted return potential from here on.
Right. In terms of mutual fund flow data, what is the sense that you're getting? Inflows continue to be strong, and irrespective of markets, market movement, valuations, you're continuously seeing better flows?
I think the momentum has been maintained because of the entire ecosystem and the education drive done by various partners, mutual fund companies and the media, as well as a far more seasoned investor base who have seen the benefit of actually staying in markets over a period of time rather than wanting to time the market. So I think that message has gone through loud and clear. We continue to see greater mobilization of SIP flows into mutual funds. So I don't think it's so much that regardless of valuations, investors are coming in. We clearly believe that we are just at the start of the economic recovery from an overall cycle perspective is concerned, and therefore yes, from a very near-term perspective, markets may have run up too soon, too fast. But from, say, a 3 to 5 year perspective, we definitely do think equities as a very attractive asset class, and therefore we continue to recommend equities, albeit coming in through formats like SIP/STP at this point of time.
All right, Mr. Krishnan, this is Anisha also joining in. If you look at the Kotak Top 50 Fund, you are quite bullish on the cement space. You said that the economy is on the cusp of the new economic recovery cycle. Is that how you will play the recovery?
I think cement is one of our preferred sectors, along with auto and selective capital goods and private sector franchises on the banking side. So these are the 3 or 4 key areas where we are reasonably positive with respect to benchmarks. Specific to the cement sector, the way we see it is over the course of the next 3 years, incremental supply is going to be far lower compared to incremental demand. Over the last 4-5 years, from 2010 to 2014-15, supply kept on coming in with demand continuing to surprise on the negative side, and that created a lot of pressure on pricing. Along with that, profitability took a hit. In our opinion, over the next 3 years, cement is in a sweet spot wherein incremental supplies haven't been announced, and there is potential for demand to come through now because of the various spending programs of the government. That's point number one. Secondly, the entire sector is seeing consolidation happening. The stronger players are getting more of the capacity share compared to the weaker players. Whenever that happens, in our sense, that brings in pricing power to the sector as a whole. And therefore, these are 2 mega trends at this point of time, which makes us supportive of the overall cement sector as a whole.
Mr. Krishnan, what is the sort of IPO markets that you would look at? You think that has developed quite well? We had a very good listing of PNB yesterday. Some of the earlier listings have also been done. So anything where there is something left on the table is attracting flows?
So clearly, I think the IPO window has received a positive or an encouraging response as far as investors are concerned. Primarily because of two counts. I think most of the IPO issuances have been, either sale by investors, which means that really, these are great quality franchises which don't require so much of capital for growth, and therefore there really isn't so much of problem of dilution or taking on debt, etc., to finance their growth. So that's one set of companies. There's another set of companies which want growth capital. So that's again given a thumbs up. I guess the set of companies, where, for example, various asset owners, which require capital to repair their balance sheet and to come out of their huge leverage positions that they have, that is still not yet reached that kind of an encouraging response. So these first two set of companies, which either don't require any capital for their growth journey or which require growth capital, have received encouraging response at this point of time. We are cognizant of a lot of such issues. Our preference has always been to look at capital efficient businesses, because that to us is a very strong metric which can sustain and grow their capital over a business cycle, and that's the kind of preference for us when it comes to the IPO market as well.
Right, and say if it's a good strong brand where you mentioned about dilution earlier. If dilution is low and some investors are exiting, it would be an opportunity for a player like you who's looking to buy big chunks or large chunks at the first go? Absolutely.
I think, like I said, companies which don't require capital, wherein investors are actually selling off, and therefore no money is going into the company, is actually a huge vote of confidence in the business model of the company itself. The fact that they don't need capital to continue their growth journey. So we are highly encouraging of such franchises.
All right, Mr. Krishnan, coming back to the Kotak 50 fund, you said you like cement. You also like autos. Within the auto space, which are the stocks that you like? Do you have a preference for the two-wheelers versus the four-wheelers? How would you pick and choose?
So I think our preference has been to the domestic side compared to the exporters as far as the auto companies are concerned. We prefer again companies which have reasonably strong market shares within their particular subcategories. So we are more present in the four-wheeler side at this point of time. We also have reasonable presence in the two-wheeler segment. Our entire sense is that auto as a pack as a whole still has scope for further benefit of demand coming through, because this is very early in the cycle wherein discretionary spending is starting to happen. So of course now you've got the fillip of the pay commission, but even otherwise we've seen almost 5-7 years wherein there has been no growth for these categories as a whole, and therefore there should be a latent demand which should potentially come and surprise. Companies, leaving aside the demand equation, from a company perspective, I think a few of these companies have actually steadied their ship significantly. I mean, just a case in point would be, say, Maruti, which was pretty much absent in the entire premium space or the mid-market to the premium space, and they've come back with a huge onslaught of models and have shown their ability to actually take market share from a lot of other companies which had significant offerings on the medium to the premium side. So I think that's again encouraging that it's not only the demand side, even from their own company perspective, there are companies which have actually worked up on their pipeline of models, have identified gaps and have executed well, and we are appreciative of such franchises.
Okay, so we've got your views on cement as well as auto stocks. Mr. Krishnan, when it comes to the private banking space, you've liked a number of leaders. In fact, I think HDFC Bank has a large allocation in your fund. Don't you think some of these are very richly valued now? We've seen earnings coming in from Axis and ICICI, and there are worries on asset quality, even though the situation seems to be improving. What do you think will be the fillip for these private sector banks?
Sure. I think when it comes to private sector banks, the way we look at it is there are banks there are lenders which are focused on the retail side primarily, and there are lenders which are focused on the corporate side primarily. As far as the retail lenders are concerned, I think they've been fantastic compounding stories. They have taken on market share in a very disciplined manner, grown their balance sheets without recklessly growing ahead of either their demand, either ahead of their deposit growth, or without diluting their risk standards towards lending. And here we think there still is room for growth as far as further increase in market shares is concerned, as far as the core retail lenders is concerned. And you're right, they are very richly valued, so we don't really think that there is room for re-rating from these levels, but it's more a earnings compounding story that we really are playing. Now, as far as the private sector corporate lenders are concerned, I think you make a very valid point. As far as corporate banks are concerned, I think the way we are playing it is that there are two cycles. The first cycle is basically the cycle of the past, wherein there are losses being crystallized today as far as the asset quality is concerned, and then there is the cycle which is lying ahead of us, wherein hopefully the private capex kicks in, and then you've got the corporate lending starting possibly in FY18 and beyond. Now, the way we see it is, yes, as far as asset quality is concerned, there are near-term worries, but we think by end of FY17 and possibly early FY18, most of the assets or the bad assets would at least start getting recognized. While there will still be credit costs associated with aging of those assets, but by and large, I think that would mark a clear crystallization of losses as far as the previous cycle is concerned. Now, as far as the next cycle is concerned, I think what we really are looking for is companies which have three aspects right. The first aspect is capital. Are they adequately capitalized to cater to the growth of the next cycle? And here clearly, private sector corporate banks score quite nicely as against state-owned lenders. The second thing is, are they technology adaptable? Clearly, we are seeing, the overall market moving into newer forms of technology as far as the banking sector is concerned. And here again, we think few of the private sector banks are in reasonable advantage position as far as them catering to this new technology is concerned. And third is as far as human resources. We think that on the PSU side, there are going to be significant amount of retirements that continue to keep happening. And if we take a fundamental step back and forget about the near-term asset quality issues, we clearly feel that private sector corporate lenders would continue to grow ahead of their state-owned lenders once the growth cycle starts. Maybe it could start in 18 or possibly in 19 as far as the next growth cycle is concerned.
All right, so we've got your views on the private sector lenders as well. You also mentioned that you are picking up some of the or you're overweight in some of the capital goods stocks in a selective fashion. Now, what is leading to this optimism? Because we're not seeing industrial capex pick up on the private side at all. There is a hope that there will be a turnaround, but on the ground, we're not really seeing a pickup. How do you pick up? How do you choose in the capital goods space? Do you look at the shorter end capital goods players and invest into them? How do you pick up there?
You're right. So clearly, from an overall gross fixed capital formation or the investment cycle, we think there are four legs to that entire equation. The first leg of spending is from the public or from the government side, which clearly, as we've all known, has actually picked up quite materially. So be it in roads, railways, defense, these are all areas which are government-led spending. I think there we've got a strong positive flow coming through. Second is private capex, which has been pretty much absent, I would say, for the last 3 years, and our sense is at least under 2 years, we don't see that reviving in a hurry. Third is as far as housing is concerned. Now, housing is a very important component of the overall capital formation. while in the urban and the tier 1 markets there is a reasonable amount of sluggishness, I think on the real semi-urban and the rural spaces there are some sparks which are coming show through as far as housing sector is concerned. And the fourth is of course the asset owners. When they get onto their full animal spirits and start bidding out. So out of these 4 legs, currently I would at best say 1.5 legs is firing, which is basically public capex is firing at this point of time and possibly some bit of housing. Now, if you go back to the earlier investment cycle of 2002 to 2007, the first half of the investment cycle, say 2002, 3, 4, was entirely led by capital goods and light engineering companies. It is in the second half of 2005, 6, 7, wherein you had various asset owners growing by 50 to 100x, whereas the first half was entirely led by these what we call flow-related opportunities, which benefit from public spending. So our sense is over the course of time, this 1.5 levers will slowly start moving to 2 and hopefully 3 and 4. And at this point of time, maybe we are a bit early into that cycle, but we think that the investment cycle is starting to show some signs of pickup, and which is why we are selective. Yes, you're right, we prefer the early cyclical light engineering companies, which have done a lot of capex, wanting to grow ahead of the next cycle coming in, and which are linked more to the public spending rather than to the private spending.
All right. Mr. Krishnan, thank you so much for speaking with us at NDTV Profit.